Okay, good afternoon, everyone, and welcome to the 8th Annual Laurentian Bank Securities Institutional Investor Conference. My name is Nick Agostino, Head of Research and the Diversified Technology Analyst here at Laurentian Bank. My associate, Salman Rana, is also assisting me today in the background as the moderator for this fireside chat. Before we begin, just one housekeeping item. Please ensure your microphone is on mute and your camera is turned off during the presentation. Please ensure your name appears on screen so we can properly address any questions you may have. Also, we will pause during the course of today's chat should you have a question. Please either use the chat box at the bottom of the screen or the raise your hand feature, and we'll call on you when we're ready to take your question. And just a reminder to lower your hand once you're done. And if you experience any technical issues during this fireside chat, please communicate this in the chat itself, and we'll try to address it as quickly as we can. And then finally, we've also added a quick guide to kind of steer you through today's discussion. You'll see that on the bottom of your screen on the right side, and it's got the ticker VNP for 5M Plus here. So with that, we'll get started. Introducing today's speaker, we've got AJ Roshan, who's the President and CEO of 5M Plus. Welcome, AJ.
Thank you, Nick.
So getting right to it, we'll dig into electronic materials. Obviously, the sizable piece of the business and a good EBITDA margin driver for you. So how do you, looking at your renewable SaaS medical imaging, organic growth is something that I think the company, as much as you've turned over sales from a quality of sales, now that you're going into M&A and growth mode in general, how do you guys position yourself to drive organic growth within those key segments? And in so doing, is retooling or bolstering the sales staff part of that strategy?
Well, we think that our renewable energy business, renewable mainly solar, will continue to be a business that's going to continue to grow for obvious reasons with the demand that's there. We think that our best estimates tells us that's a business that'll continue to have some cost pressures. So we've already prepared ourselves to be able to really thrive in that market by being able to grow our volumes. Now, we know that revenue per unit of volume may go down, but we're also, through process technology, are reducing a cost per unit of volume. So we think we'll be able to protect our margins and continue in terms of volume grow with that market. On the space, security, aerospace, sensing and imaging, what you mentioned, that's a sector that we're quite excited about. We have launched new products. This is all part of the new 5M Plus, where we're really going down the path of technology, semiconductor technology in this case. We have introduced new products, and we see, I would say, somewhere between 7 to 10% revenue growth at good margins over the next 3 to 5 years. Specifically, with respect to medical imaging, this could be quite a notable growth driver for us because we are really coming out with a new technology which the big CT manufacturers are embracing. It takes a little bit of time to get it through all the qualifications, FDA and so on. But at the current trajectory, we think if we continue, this could potentially be a disruptive technology in the market. And in fact, part of the reason why last year we performed so well was because one of our key customers was building up their pilot line, and it drove the demand. Now, I think there'll be ebbs and flows. There'll be years where, because we're still building up to really industrialize, so demand will be net going up, but it'll be a zigzag shape.
Okay, and you mentioned First Solar in there. Obviously, you've got the renewed contract with them, more back-end loaded, as you said, probably margin compression coming off that contract as we go forward. But that relationship has been a sizable top-line contributor even to this day, and for that matter, profitability. Now that you're bringing Azure into the fold, maybe if we look out 5 years from now or even 3 years from now, how big of a piece do you think First Solar is on your overall company? 5 years out.
A couple of things about the whole solar space is indeed the demand pattern is really disjointed from what the news in the media is. And this we often have this with our analysts because they say, well, First Solar announced a new plant and their stock goes up, and everyone says, well, then your demand must be going up. In reality, that's not how it works. Without getting into details, because I don't want to obviously divulge what the strategy of the client, but how we provide to those companies is actually different than what the flow in the media is in terms of their buildup of plants. So indeed, in 2021, for example, we think that the demand is going to be, they haven't reduced their demand for our product. It's just the way it's been distributed. It's going to be less, and it's going to be more backloaded more into 2022. Now, in terms of actual contribution to our top line, indeed today it is between 20 to 25%. It used to be much more than that. The reason why it's reduced is not because we're losing business; it's because we are really growing other businesses. I expect us to grow other businesses at a higher rate of growth. So if that number were to come down and it's now sub 20, it's not because we're having problems in solar. It's just because we're growing other businesses. And as you mentioned, Nick, indeed, we believe that the recent acquisition is a part of that. Is going to continue to diversify the revenue stream.
Okay. And then, so looking at margins and just quoting some of the numbers you've thrown out recently, you've indicated using the electronic materials, you've said that you think that the business could be EBITDA margins of 30% plus. And you said you can get the eco-friendly margins up to that 20% plus level. Now, I'm not sure how you want to respond to this, given that you could potentially restructure the company or redefine the company using specialty semiconductors and performance materials following the Azure acquisition. But regardless, the question is, when you look at those electronic materials numbers, the margin numbers, considering you're at 30% today, plus or minus, and now you're adding the epitaxy technology, you've got the micro powders, which experience shows that it is a very high margin business as it gets going. Are you being conservative when it comes to electronic materials numbers? And if that's not the case, then should investors be looking at this business as more of a top line growth, and where the margin expansion opportunity really comes from is the eco-friendly side as we go from, say, a 10% range up to that 20%?
I think the way investors should look at 5N Plus is, here's a company that, 5 years ago made most of its gains from essentially movement in metal prices. And it is basically abandoning all of that practices and is moving really toward gaining its earnings through margins that are based on their technology, competitive product, and so on. Which means what? Why do I say that? It's because we're developing, when we talk about, for example, additive manufacturing, it is not a business that today, we just entered it like 6 months ago. We actually tied up with Metal Pine and ourselves have launched some products. We're really going after that market. So it's going to take some time to build that up. And as people know, when you're building up a business initially, you're not getting your full operational leverage. Your costs aren't getting diluted yet. You put a lot of things in there. So that needs to happen for something, let's say 3D printing. And that's a market that is growing at 25% per year. We believe we've put together a very good ecosystem in that. And so that's, we think that'll continue. Now, this story is true with electronic material. Electronic material, when you run a healthy electronic material, and this is benchmark in the industry, this is not just 5N, it should be a 30% or 20 to 30% EBITDA business. We see that, for example, as we go into these new products, we certainly can get there. And we're trying to build up to that. In the whole semiconductor space, we're trying to essentially build up so that we can have enough operational leverage playing in the game to essentially allow us to get to that point. And we see a clear path. Now, the other part of our business, which today is eco-friendly, but in the future is more along the line of performance materials, that has, for example, pharmaceutical businesses in there that does also provide very good margins. The challenge we have there is we're like 70% of the TAM. We don't want to really expand into that TAM. We have to bring in new TAMs. So that's why we're getting into the M&A mode in that space as well. The recent deal that we announced with the equity that we took in Microbian, and we're quite active in the market to try to expand our active pharmaceutical business to be able to get there. But I do see us, the trajectory that we're on, based on the materials and spaces that we're playing, and the M&As and growth initiatives that we've put in, that I do see us getting to a 30% business. It's just that some of these things, as I said, we have to be able to climb up the industrialization phase into the commercial phase so that we can take full advantage of the operational leverage.
Okay. And then I think about a year ago, you introduced a new product in the semiconductor space, and I just got to call it out as INZ.
INSB3.
There we go. There we go. So maybe, obviously, a new product introduction. Talk to us about what the reception has been like since its introduction in the marketplace, and where margins on that product sit specifically relative to your overall semiconductor basket.
So this is an interesting area. It's an area where we are actually able to use research money that is provided to us by government to develop infrared imagery to also then apply it to medical technology. This is why whenever you hear us mention infrared, medical imaging is also next to it, because essentially you're developing something here which is more on the governmental side, but then there's a big commercial market that supports it. Now, in the case of INSB3, this is, we developed this product, and when we went out there with 5 major global players in infrared imagery, we won 4 of those tenders. And so it's, again, another reason last year, a big reason why we had a good year, good margins, very, very, I would say one of the best margins on the books, is because medical imaging, infrared imaging did really well. And this was part of that. INSB3, we had an uptick of demand. The margins was well above the normal electronic material margins. So that's been quite a good reception, and we've already these companies have already come to us, and they're asking us now to develop the next generation of products for them, and that's where we are now. We're moving to the next generational product for their next product lineups.
Okay, and then there's been a lot of talk in the marketplace recently about semiconductor shortages. Especially, we hear it on the EV market. Can you speak to whether that shortage has been something that's impacted you from a components perspective in terms of input products, whether you've even had shortages within your own organization, and more importantly, when it comes to the EV market in general, and given the specialty nature of that market, is that an opportunity for you guys down the road for growth? And if so, what sort of form factor do you need to deliver on the product side?
I would say absolutely. It's a great opportunity. Today, none of the US satellites would be able to go up without our materials. A lot of the infrared imagery wouldn't happen without us. And so this is one of the reasons there is quite a bit of emphasis by various agencies within US government to make sure that 5M Plus continues to thrive. And you've seen, for example, late last year, we had the $12.5 million program that came to us from DoD. And this has just reinforced it. It's just reinforced that here's a company that has unique access to the metals that are needed. These are very special metals. And then they can take these metals, take them through a series of technology-based processes, and really get to a semiconductor wafer. And now with the acquisition of Azure, it's going to be epitaxy, which is even further customization of these, and all of this in all friendly territories, somewhat independent from, not fully, you're never fully independent, but somewhat independent from some of these geopolitical things. So the segments that we're playing in, it's obviously has really elevated our position in front of our customers, in front of agencies. We think that with the acquisition of Azure, we're actually going to be going into the wide bandgap material, which is in anything from electrification to communication to high power electronics. And we're building what we call the triad, the semiconductor triad, which is basically Montreal doing all the high purification of semiconductor products and procurement. St. George, Utah, doing all the activities around growing them into wafers of semiconductor, and Heilbronn, Germany, really growing the epi layers to customize them, whether for electric car, whether for communication, 5G, or what have you. And so this is the only company in the world that we know that's going to have this triad, that's going to have this unique access from getting access, extracting these metals from byproducts all the way to a semiconductor finished epitaxy product, and all of it within, let's say, friendly territories. So we think that whether the global system becomes a dual supply chain environment or not, anybody's guess. I'll leave that up to the pundits. If it doesn't, we have this advantage. If it does, we have even a bigger advantage. So actually, we think we're well positioned with what we've done so far.
Okay. So shifting gears to the eco-friendly side of the business, obviously, as part of the new strategy, you've indicated in the past, or recently, that you probably look to exit the catalytic and the extractive markets, the industrial markets. Just any update there as far as have you had conversations? Is that something that you guys are comfortable you'll be able to, by exit, you'll be able to sell, or is there not maybe potential demand that maybe you would have to just do an outright shutdown?
So maybe I'll back up a little bit and just put a couple of things in perspective. These aren't bad businesses. It's just not the place we're going in the future, right? We're going down the path of more value-added activities, technology-based. Our view is very, very now straight and narrow. It's specialty semiconductors and performance materials, and these are neither, right? These are chemicals. A lot of them are chemicals. And so we're saying, look, these businesses are actually, they've been optimized now. They're for their own activities, they're very competitive. It's just 5M plus of the future is not a place for them to thrive. We need to, as responsible managers, we need to find other places for them to thrive. That could be outright divestiture, that could be joint venture, that could be any option. That's really what's happening in the background. We're looking at our options. We have to also consider people and make sure that we do the responsible thing. So we're going through that review. In terms of shutting it completely down, it's not that they don't have an order book. I mean, if you look at catalytic and extractive, if anything, the order book for that activity is full. It's just not a business that we want to continue doing. Look, I guess the positive thing is there is so much working capital in these businesses that even if you were to assume, not that that's what's going to happen, that you were going to shut it down, you still would free up a bunch of cash. Okay, so we think the responsible thing is for us to continue to be more focused on the items that I specified and really apply our resources in that direction, especially now that we've begun to really go the path of M&A. We need to get maximum resources allocated to that so that we can expedite our growth. I should be able to give you more visibility later in the year, but right now I think that's as much as I can probably share.
Okay. So you mentioned M&A, you mentioned growth. So maybe moving on to the next area of discussion. Obviously, with the Azure acquisition and before that, you've indicated that over the next 5 years, you see your TAM going to 1.5 billion, maybe upwards of 3 billion, and that's versus a current, $500 million at the top end. And as you pointed out earlier, getting into more of the ultra high purity expertise markets, getting away from metals and all that stuff. So the question becomes, as you execute on this plan, why is now the right time versus, say, having done this 2 years ago? Like, what do you guys see now that gives you the comfort that you're early as opposed to maybe not necessarily late, but just maybe not quite ahead of the game?
Yeah. So I guess I have a confession to make here, and that is we've been engaged in this process for at least 2 years, or if not more. If it has taken us this long, it's not because we started late or early. We've been very selective in terms of in this space. Let me explain that. I think the investors, if they go through the pack, we've put some comps in there. They should see that if you're trying to get into this specialty semiconductor, multiples of north of 20 is like the starting point. And when we started doing this, actually a couple of 2-3 years ago, we were in single digit. It's only recently that our multiple has become double digit. And so it was, we said, look, we're going to have to find a creative way of doing this to be able to create value. We weren't going to just pull the trigger for the sake of saying we did a transaction, now we're in these markets. We had to not overpay. That was, I think that was the responsible thing. So it took us some time. It took some creativity. I think when you look at the Azure play, there's a bit of creativity in there. We've taken a space company with space technology that historically hasn't done a lot of commercial work on Earth for earthly products. And now we're going to use that patent and that expertise, which is really congruent to everything we need to do on Earth, and apply it. And that is not evident unless you're deep into the bowels of some of these things. It's not, it's not something that is evident to everybody. And so I think it took us some time to find an elegant way of being able to get a deal that was at the right value, that would not dilute our shareholders, that would be the right one. I would, to my own demise, maybe I would tell you that the next deal will be the same. We'll be judicious. We will, if it takes us a little bit longer, it takes us a little bit longer. But we're going to start building, we're building a nice little Lego blocks. We're going to put things together, take our time, make prudent decisions. So I wouldn't tell you we were late. I would just tell you we were super selective, and it took us a while to get what we wanted.
Okay. And then when you look at what Azure brings to the table, and certainly the patent is what gets the IP that these guys have, the epitaxy, and the ability to go into wideband semiconductors you alluded to earlier, that certainly gets me excited about that transaction. When you look at when you guys think you'll be ready with product, and let's call it 2025, similar to the last question, do you feel that from a timing perspective, even though you sounds like you would have loved to have done Azure, say 2 years earlier, do you feel that when you're ready to go with product for these new markets, do you feel that you're timing the market perfectly is probably a strong word, but at least at the point where we start to hit that inflection point upwards?
So Nick, I've had the pleasure of being in the material technology business for a couple of decades, and I've had some successes, and I've also made some mistakes. One of the things I learned is you never want to be the first wave out. If you do the study in the material technology, the people that come out in the first wave usually get shot. It's usually the second, third, maybe even fourth wave, because you learn and you adapt and so on. Just look at, for example, cell phone. Motorola was the king, and where's Motorola today, right? Same thing in material technology. So I'm not, even if you had Azure 2 years ago, I'm not sure the market would be there yet. Right. Look, the whole, there used to be a saying in semiconductors, don't bet against silicon. It's just like, I'm an old automotive guy. It used to be don't bet against SI engines until you do. And what happened with SI engines? Batteries have become so much more efficient and viable that now the world is seeing that direction coming. The same thing is happening to silicon. If you want to get, if your 5G phone that runs at 6 gigahertz, if this thing's going to download all the data that you want it to download fast enough, silicon is reaching its limit. So on the 6G, 7G, you can see it. You look at the roadmaps of all the phone makers, they need to go to wide bandgap. Similar things in electrification. Today, maybe you're willing to sit 4 hours to get your electric vehicle charged. But you're not going to tolerate that a few years from now when wide bandgap can be brought to market at reasonable levels and allows you to charge 80% of your vehicle in 20 minutes. So this wave is coming. Now, the question is, are you at the front of it? We've made a decision to be fast to follow. That's our strategy. We're not going to be leaders. That hasn't, my experience in this sector tells me, be the second or third guy, sit back, learn from the mistakes, and then strike. And this is where we're coming. So what I would tell you is that by 2025, the things that we have in front of us are the following. Part of the deal with Azure was that they had to, before us going forward, part of the deal had to be that they would bring the full IP portfolio of wide bandgap. If you go online, you'll see that they've purchased all of that from essentially from two places, Alos and Madrid University. So they have access to the full IP side of it because it's heavily IP. And then the other thing is some of the upfront investments had to be made already. So where Azure is, they have the IP, they've got the assets, and they've begun to do sampling of some of these. We expect that by our entry into the market won't be before 2024, because between now and then, we've got to go through sampling, qualifications, and the market itself today, we think is probably not ready to fully take off right now. It's going to take a few years for this ramp to come up. And that all comes with introduction of new vehicles, charging systems, communication system, advanced technology. As those things, just like if you look at 5G, it took a while for 5G, but now it's ramping up. So as those ramp ups happen, the need for these materials will take off as well.
Okay. And when we look at kind of like the current 5N plus, obviously you're a top player in the business market, top player in the tellurium market, but obviously highlighting metals here. What kind of, if we were to look out 5 years from now, where do you want to be known as a top 3 player?
I'll tell you top 2 player. The top 2 player is going to be, we want to be a top player within specialty semiconductor. And you may say, well, what the heck is that? That's family of 2,6 and 3,5 materials, which are often needed in renewable energy, electrification, communication, medical and infrared imaging, aerospace. So in a family of 2.6 and 3.5, we want to be maybe top 3, better yet top 2. We're used to being top 2 whatever we get into, so hopefully that would be top 2. And then on specialty pharmaceuticals, I would tell you is the second space. Today, we are the world's largest producer of pharmaceutical products based on bismuth chemicals, which is mainly for gastrointestinal conditions of all sorts. We want to really expand that portfolio beyond bismuth into other areas that are, again, congruent, similar play to what we did on electronic. And we want to be top in those 2 areas. And I think with that, we will have a really nice leverage. You have 2 businesses that are actually very much at the base a high purity business. That's what connects them. That's what makes them essentially viable for us. But in terms of their markets are very different. And now you have a company that is let's say it's less cyclic than it would be if it had one or the other.
Okay. And then looking at contracts in general, I'm sure you'll agree that in the past, when the word around pricing contracts was discussed, it was always a function of either the spot market tied to metal prices or discount to that to those prices. So you were very much tied to the curves in some shape or form of those metals. As you move away from metals and you become more of, compound substrates, IP for that matter, that you guys are bringing more and more to the forefront, how should investors be looking at how you price contracts?
Value-based is the short answer. In fact, we've even had a turnover in our sales force because you're right. In the past, it was about metal and then a margin to the metal. Look, 5 years ago, a 30 to 40% variation in metal price would have, 35 to 40 million, I think, hit to our bottom line, hit or improvement to our bottom line. We've now demonstrated that we're down to about the same fluctuation in metal has maybe 10 million impact. And where we're going is it's going to be probably in 5 years, no more than 3 to 4 million. So metals will still have some impact, but we're going to mute this so that it's not really a major event. And the way we will price ourselves is not based on index to metal. It's based on value. When you sell a wafer, it shouldn't matter how much metal is on it, a semiconductor wafer or an active pharmaceutical ingredient. It shouldn't matter because reality is it isn't a lot of metal. I may have given this example before to you. Like, for example, some of these semiconductor wafers, one wafer could be as much as $2,000 for some of these high-end infrared applications. Well, the amount of metal is $50. But it's the value to the end customer in terms of when it goes to a very high-end infrared imaging or medical technology. We're going to use value-based pricing rather than indexing or cost plus. It's all based on value-based pricing in the future.
Okay. And well, I guess two things. Recently, there was I know you guys saw the critical metals list, and it looks like bismuth, germanium, gallium, indium, tellurium, for that matter, were all on that list. What does those metals being on that list mean for you, I guess, today? And does it mean much to you guys, say, 5 years from now, if those same metals are called out?
We always try to, we're a company that works closely with government agencies in the sense that we're part of that community, but we try to really develop our own commercial businesses. Even like when we do products for government programs, there always has to be an angle on the commercial side. On the metal, it's the same thing. The list has come up. Indeed, a number of those metals are things that we're strong at. But history has shown us that it all depends on the enforcement, right? I mean, rare earth 10 years ago wreaked havoc and everyone thought the whole supply chain will change because of it. And guess what? It didn't. Now, again, it's coming up because this time they say it has to, and so on and so forth. So I don't know how much this is going to be an impact, but I can only tell you for us, it could only be positive because we're a company that 5 years ago learned that you can't just go, to the extent that you can help yourself, you shouldn't just go and buy these metals for metal. As much as you can, you should try to extract them using process technology from secondaries, byproducts, because it makes you somewhat independent from the people that try to corner the market. And so we are a company, especially in the metals you mentioned, that we're the biggest purchasers of bismuth, we're the biggest purchasers of tellurium. We purchase quite a bit of germanium. These are metals that we have internal capabilities to be able to extract these and buy them rather than buying them as metal for metal, at least a large portion of it. And so to that end, us having this capability, having access to a diverse group of people that have the byproducts, I think makes us that much more valuable because one of the reasons why our customers come to us, they know we're not the cheapest in the market, but they come to us because of our reliability, not only just quality of product, but they have access and reliability. And so with lists like this being out there, it's just going to increase our value and worth to these customers because they know with us, they have a source of reliable products.
So on that access to the products, I know in the past, I think various, the U.S. government would have been part of this with rare earths, the idea of trying to make sure they almost saw it as a piece of business that they want to have their hands around, so that they had access to, because of, in some cases, the military nature associated with those metals. So they were very much perceived as being strategic. In today's world, we're seeing with the pandemic, the countries that are doing the best when it comes to vaccine and vaccine rollouts, looks like to me it's the UK and the US, and there's certainly two countries that developed the vaccine and have a better strategic control of those rollouts. Do you think that now that we're in this pandemic, do you think that maybe government's view on getting ownership, or at least strategically wrapping their arms around some of the metals that you play in, has come back to a level of importance given what they're observing from the pandemic?
I think it has. I think certainly the awareness is there, and they realize that it is quite critical. The question is, it's not the what, it's the how they will address it. Okay, they have addressed it now, it's critical, and now they're working with partners like ourselves to develop these things. But how will this be addressed? Let me give you an example. Many governments, including US government, has access to what's called stockpiles of their hardware that has so much of these, whether even rare earth, but minor metals in there. And up to now, there hasn't been a clear industrial policy to really put this into use, because it's substantial. It's been collected for years and years and years and years. And so one of the things, for example, that we're engaged in is to tell the US government, there's this above ground mine that is your stockpiles. Let's work with you to valorize these, to extract. So the awareness, Nick, is there. It is increasing. The importance of it is increasing. What is yet to play out is how will they address it? Will they really start from the low-hanging fruit, which are, as I'll give you an example. That I think there's still more work to be done there, and we're engaged. We're engaged in this process, certainly in the areas that we have expertise, and we should see how that goes in the future.
Okay, so one final question. I think we've got about 2 minutes left. When you look at your share price recently has had a nice run up, I would say, for the last 5-6 months. So certainly congrats on that. You've communicated to the market your new focus for the next 5 years to increase the TAM. You've executed with Azure, bringing the IP in-house to be able to execute on that TAM. But when I look at your trading multiple relative to some of your peers out there, there's still that discount, which presents opportunity for you. Do you think that, over the last 2 years and over the last 6 months, is there still a part of the story that the market's not understanding, or it's maybe misunderstood? Or do you think the market is now coming around to understanding what you're doing, and it's just on you guys to just execute on that front?
I think there are a couple of factors here. One factor is there's still people, and I meet investors almost every, I won't say every day, but certainly every week. They're still, referring to us, aren't you guys the metal company that lost, 100 million in 2015? This is still, there are people that still, that's their awareness of 5M Plus. And then, for those that are engaged in the story, pop up the hood, they see the engine there's completely a different one now. So there's a bit of that. The other part is the company, let's be honest. I mean, for as small of a company as it runs like a international conglomerate. It's very complex. Materials, even look at large material companies. They're always misunderstood because materials are not the easiest thing to understand. You're behind the guy. Sometimes they're called kingmakers because you're behind the person that actually makes the device. So it's not really clear what you do, what your value proposition is. So I think one of the things we've begun to do, and over the past several years, is actually simplify our story. That's why you see in our literature, we say, we need to go deep, not wide. That's why we're beginning to now even consider becoming even more focused. We need to be able to get out there and articulate our story more quickly. And now we can, and we're going to make it even more succinct. So I think there is a bit of that still really investors are beginning to understand and appreciate. I think our valuation, okay, every CEO probably says this, is still substantially lower than if you look at the peers in the investment pack. We've put some peers. I think we just need to continue to execute. I think we need to continue to simplify our story, continue to go down the path of technology, continue to expand our margins. I think now the game is also start growing our revenue. Up to now, let's be honest, our revenue has not grown because we've been taking out commodity stuff, replacing it with technology, but we see now that inflection point is coming, and now we're going to be going down the path of revenue growth. I think once these things come together, I expect that we start closing that difference and maybe even get ahead, because hopefully we'll be the best of breed.
Excellent. So with that, we'll end this call. AJ, appreciate your time. All the best. Stay safe, and look forward to doing this again next year, but this time in person.
Thank you. Thank you.
Thanks, AJ. And just a reminder to everyone, we've got Callium coming up at 3:20.